Picture this. It's a Tuesday evening. Nothing special about it. You're sitting on your couch, maybe still in work clothes, maybe already changed into something comfortable. Your phone is in your hand. You open your bank app, not because anything is wrong, just to pay a bill before you forget. And then, before the screen you actually came for even loads, a pop-up appears. Help us serve you better. Please update your annual income. Your old number is already there, pre-filled, almost politely waiting to be corrected. There's a little text box, a little cursor blinking, and you think, sure, why not? They're just trying to keep their records accurate. Seems harmless. So you type in your current salary. You hit submit. The pop-up disappears. You pay your bill. You go on with your evening. What you don't know, what almost nobody knows, is that the moment you pressed that submit button, something else happened entirely. Somewhere in a server farm you'll never visit, an algorithm woke up, and it started making decisions about your financial life. Decisions that have absolutely nothing to do with serving you better. This video is about what actually happens when banks ask for your income, and, more importantly, what you can do about it. Let me tell you something that might genuinely surprise you. Banks are not legally required to know your income. Not for your checking account, not for your savings account, and shockingly, not even for most credit cards. There is no federal regulation that says your credit card company must have your salary on file, no law that says they're entitled to updated financial information mid-relationship. So here's the obvious question. If they don't have to ask, why do they ask? Here's the honest answer. Because knowing your income makes them more money. That's it. That's the whole secret. Strip away the friendly language, the customer service framing, the helpful little forms, and what you're left with is a very simple business calculation. Your income is a weapon. Not a weapon that hurts you physically, a weapon that gets used on your wallet, quietly, algorithmically, in ways most people never connect back to that innocent-seeming pop-up they filled out on a Tuesday evening. Now, I want to be clear about something before we go further. I'm not here to tell you that banks are evil. I bank, you bank, we all bank. Banks provide genuinely useful services, credit, loans, accounts, infrastructure that makes modern economic life possible. But banks are also profit-maximizing institutions, and profit-maximizing institutions use every tool available to them. Your income data is one of those tools. The question isn't whether banks are good or bad, the question is whether you understand the game you're playing. Most people don't. Most people treat income questions as routine, like being asked for your zip code or your date of birth, something you just fill in without thinking. Banks have worked very hard to make it feel that way. The forms feel official, the requests feel standard, the whole experience is engineered to normalize compliance, to make you feel like providing this information is expected, maybe even required. It isn't. And once you understand what that information actually gets used for, you might think twice before typing it in. Okay, let's get into the actual mechanics, because this is where it gets interesting. When a bank receives your income data, it doesn't just sit in a folder somewhere. It immediately becomes an active input in multiple algorithms running multiple calculations about you simultaneously. Let me walk you through exactly how each one works. Credit limits, the kindness that isn't. The most obvious use of income data is credit limits. Higher income, higher limit. Simple, right? Seems fair. Except, here's what they don't tell you. A higher credit limit is not a gift. It's a calculated business decision. Banks have studied human behavior extensively. They know that people with higher limits tend to carry higher balances, not because those people are irresponsible, but because the psychological limit shifts. When your ceiling is $5,000, you think carefully before reaching $3,000. When your ceiling is $30,000, $8,000 feels fine. Higher limit means more spending. More spending means more balance. More balance means more interest. More interest means more profit. The bank isn't rewarding your success. They're opening a larger door and betting you'll walk through it. Interest rates, the part that will genuinely anger you. This is the one that took me a while to fully understand, and when I did, I had to sit with it for a minute. You'd assume that higher income means lower interest rates, right? Lower risk borrower, better terms? That's how it should work. But here's what actually happens. Banks don't just calculate your risk, they also calculate your price sensitivity. Price sensitivity means how likely are you to notice and care about the interest rate you're being charged? How likely are you to shop around, to call and negotiate, to close the account and move your balance somewhere else? And here's what the data shows. High earners are often less price sensitive. Not because they're lazy, because they're busy, because a few percentage points difference feels like a rounding error when you're focused on other things, because the inconvenience of switching doesn't feel worth it. Banks know this. The algorithm knows this. There's actually a term for what they do. It's called ability to pay pricing, and it's exactly what it sounds like. The more you can afford, the more they charge. Not because you're higher risk, because they can get away with it. The marketing machine. Your life sorted into a folder. The moment you reveal your income, you get filed. Not in any dramatic way, quietly, algorithmically. A new category tag gets added to your profile, and suddenly every marketing system the bank runs starts treating you differently. High earner? Here come the premium card pitches, the $550 annual fee cards with the airport lounge access and the concierge services, the wealth management consultations, the personal loan offers framed as exclusive opportunities. Every banner ad, every email, every notification calibrated to your income bracket. And lower-income customers get a different kind of targeted treatment. Fewer premium offers, but more predatory ones. Balance transfer promotions buried in fine print. Personal loan offers at steep rates, dressed up in friendly language. Either way, the income data is working. Either way, it's working for the bank. The part nobody talks about. Data has a long half-life. Here's something that took me by surprise when I dug into this. That income figure you typed in 5 years ago, it might still be influencing your banking relationship today. Banks don't throw out data. They store it. They layer it. They use historical income data alongside current behavior data to build predictive models about what you'll do next. And the ways this data gets shared are broader than most people realize. Privacy policies technically allow sharing with affiliates and partners in ways most customers would never approve if they were asked directly. The information you gave them, casually, quickly, just to get rid of the pop-up, didn't disappear when you closed that window. Let me tell you about someone I know. I'll call her Sarah. Sarah is a freelance consultant. The kind of work where some months feel like abundance and other months feel like a gentle reminder to check your account before ordering takeout. When she applied for a credit card a few years ago, she did something smart without even fully realizing it. She reported her income conservatively, used her lower months as the baseline, not her peaks. She got approved, the card worked fine, her relationship with the bank was pleasant, quiet, unremarkable in the best way. Then, about 2 years in, her business picked up significantly, really picked up, and the bank sent her a message. They'd like to offer her a credit limit increase. Could she just verify her current income? She thought, sure, why not? She entered her current numbers that were genuinely much higher than when she'd first applied. The limit increase was approved. And then, things started to change. First, it was the emails. Offers for premium cards she'd never asked about, investment products, exclusive membership packages. Then came the calls, representatives who wanted to discuss her financial goals, people who seemed very interested in whether she'd considered a personal loan or a financial planning consultation. The mailbox got interesting too. Thick envelopes with foil lettering, cards with $495 annual fees positioned as privileges. Sarah's quiet banking relationship had become a full-time marketing relationship. She hadn't changed. She wasn't a different person than she was 2 years earlier. She was just a person the algorithm had newly classified as valuable. So she stopped updating. The next income update pop-up appeared, and she closed it. The one after that, closed. The phone calls, she politely declined. The emails, she ignored. Nothing happened to her account. No penalty, no credit score impact, no consequence. And within about 6 months, the aggressive marketing faded. The algorithm stopped receiving fresh signals and her profile gradually drifted back toward baseline treatment. Her banking relationship became quiet again. This is something important to understand. Bank data strategies are optimized for fresh information. Stale data loses its predictive power. An income figure you entered 3 years ago doesn't trigger the same algorithmic responses as one you entered last Tuesday. Every time you update, you reset the clock. You become newly classified. The algorithms wake back up and start working on you again. Every time you decline to update, you let the clock keep running. Okay, let's get practical. I want to lay out clearly and precisely what you are and aren't required to disclose, because this is where most people have serious blind spots. Required: mortgage applications. Income verification for home loans is federally mandated. Full stop. You will provide pay stubs, tax returns, employment verification. You should provide them because a mortgage you can't actually afford is not a situation anyone wants. This disclosure protects you as much as it protects the bank. Typically required: auto loans. Standards vary by lender, but most car loans require income disclosure. The specifics depend on the loan size and the institution. Optional: credit card applications. Here's the one that genuinely shocks people. Credit card companies generally do not verify the income you report. They cannot access your tax returns without your explicit permission. They cannot see your pay stubs. They are relying entirely on what you choose to tell them. Think about that. They want the data badly enough to ask for it. They don't want it badly enough to verify it. What does that tell you about the actual purpose of the question? They're asking for a number. They're going to plug that number into an algorithm. The algorithm will run calculations. You'll experience the results as interest rates and marketing campaigns and credit limit decisions. But nobody is cross-checking your answer against the IRS. I want to say this clearly because it matters. I am not suggesting you lie. Providing false information on a credit application is fraud. It's illegal. It has real legal consequences. Do not do it. What I am suggesting is different. I'm suggesting you understand the difference between legally lying and simply not volunteering. If your income is variable, you don't need to report your best month. If you have multiple income streams, you don't need to volunteer all of them. If a bank asks you to update mid-relationship and you decline, that is not fraud. That is privacy. Completely optional update requests on existing accounts. These pop-ups, these friendly emails, these calls, all optional. Every single one. There's no legal requirement to provide updated income information to a bank you already have a relationship with. They want it, they will ask persistently, and they want you to feel like you have to respond. You don't.
Here's the thing I keep coming back to when I think about this. The relationship between you and your bank is fundamentally asymmetric. Your bank knows your spending patterns, your payment behavior, your debt levels, your financial habits going back years. They employ teams of people and run sophisticated algorithms specifically designed to analyze that information and extract maximum value from your relationship. What do you know about their decision-making, about the algorithms, about why your interest rate is what it is, or why your credit limit changed when it did? Almost nothing. That's the design. When you refuse to volunteer additional information, when you close the income pop-up without filling it out, you're not doing something aggressive or subversive. You're simply reducing the asymmetry slightly, exercising a small amount of informational sovereignty. The bank still has substantial data about you. They still see your behavior in real time. They just don't have the one additional number they'd like to have. And here's what's interesting about that. When algorithms have less stated income data, they're forced to rely more heavily on behavioral data. Your payment history, your utilization rate, the age of your accounts, the consistency of your behavior. That's data you generate through your actions, not your claims. It's harder to game. It's also arguably fairer. If you pay on time consistently, maintain reasonable balances, and keep accounts open for years, that record speaks louder than any number you could type into a form. Your actions become your profile, and unlike stated income, they can't extract that data from you just by asking nicely.
Let me give you the actual framework for handling income disclosure going forward. New credit card application. You'll need to provide income. It's part of the process, but be thoughtful. If your income is variable, your conservative baseline is a legitimate figure. You don't need to average in your best months. Report honestly within that range and don't volunteer complexity beyond what's asked. Update income pop-ups on existing accounts. Close them. Unless you specifically want something that requires income verification, there is no reason to respond. They will come back in 90 days. Close them again. Nothing will happen to your account. Credit limit increase requests. Ask yourself honestly, do you actually want a higher limit? If yes, providing income might help. If you don't need the increase, decline it outright rather than providing income data to enable something you didn't ask for. Phone calls asking to update your information. Phone calls are designed to create urgency and pressure. You can simply say you're not interested in providing that information and end the call. Your accounts will remain open. Nothing will change. Required documentation for loans. Provide what's legally required, nothing more. If a lender requests documentation beyond standard requirements, ask why before complying. The underlying principle. Update when it benefits you, decline when it benefits them. Make it a conscious decision, not a reflexive habit. I want to end where we started. You, on your couch, bank app open, that pop-up on the screen. Help us serve you better. Please update your annual income. You know now what you didn't know then. You know that this request has nothing to do with serving you better. You know that the number you type will be fed into algorithms that will use it to calibrate interest rates, design marketing campaigns, calculate your lifetime value as a customer, and make decisions about your financial life that you'll never fully see. And you know that you don't have to answer. You can close it. You can ignore the next one and the one after that. Nothing bad will happen. What will happen, quietly, over time, is that you'll have a slightly more honest relationship with your financial institutions, one where they work with your actual behavior, rather than a number they extracted from you through a clever pop-up. That's a small thing, but small things compound. Banks have trained us to feel like compliance is the default, like providing information when asked is just what you do, like the form is a contract. It isn't. It never was. You had choices this whole time. They just preferred you didn't know that. If this opened your eyes to something you hadn't considered before, share it with someone who uses credit cards, because this is the kind of thing they don't teach in school. They don't put in the terms and conditions, and they definitely don't mention in the pop-up. Take care of your money. Your money takes care of you.